Thanks for tuning into Bloomberg Quint. Well, the August monthly data that has come out from AMFI for mutual fund flows does not make for very August reading, to be honest. Picture this: equity outflows, 4,000 odd crore rupees, which is probably one of the higher ones since last 2 3 years. Third consecutive month, as I read of outflows from multi-cap and large cap schemes, and highest ever monthly outflow from mid-cap and small-cap schemes. And this is only the equity side that I'm talking about. So um, I'm happy that my two guests are joining me today because I get to ask them all the questions about what's happening to the mood of the investors, and is there more than just simply COVID-induced salary cuts leading to people needing cash flows and thus withdrawing their investments. Radhika Gupta, Swaroop Mohanty join me right now on this piece. Thank you so much, both of you, for joining in. Just quick initial thoughts. Radhika, ladies first, let's start off with you. What do you make of these numbers? It's not just 1 month number, to be honest, right? The last 2 or 3 months have been a bit shaky.
So I don't find the numbers as surprising. I know there's a lot of narrative around negative flows, and I think the industry has seen periods of long negative flows in the past. It's just that for 3 4 years, Neeraj, we've been very used to growth, and we've been seeing 5 10,000 crores of monthly flows. So this comes in. I also think you have to remember that after the cut in March, there was a significant rebound in markets in April, May, June, and people are taking money off the table because in their head what they see is a tough economic climate, uncertainty around COVID, and then rallying markets. So I think people are doing that. Some of it is rebalancing of asset allocation, which may not necessarily be a bad thing. Some of it is people who have over allocated to equities in periods like 17 and 18 and may not be suitable, and they're taking money off the table. So one, I'm not surprised, and I don't think it's too necessarily such a bad thing.
Okay, would you care to elaborate on that? And of course, what is your own experience at Edelweiss, Radhika? Because I'm guessing different fund houses would have different stories as well. But why do you say what you did? And what's the experience at Edelweiss?
So actually, the experience at Edelweiss is actually when we haven't had a negative month of flows. In fact, I think August was the best month of positive flows that we've had in our history, at least since I took over. So I think August was actually a very, very good month across the board for us, both in our domestic and international funds. We are really helped by the fact that two things. One, I think performance has held up, but categories like balanced advantage and all, which I've been a big advocate of, I think people are really turning to those kind of asset allocation focused categories at a time when they're not sure whether they want to allocate to equities. So that has worked for us. We also run a large global fund business, and international is a space. Even in the AMFI data, you'll see that that's a category that is getting positive flows. So I think both the balanced advantage and international have worked for us. So August was a fabulous month for us. But why I say that is that, I think it's not about monthly flows. I think it's about investors being allocated the right amount to equities. And I always believe that in a, bull market, what happens is people over allocate to mid and small cap. They come in basis past returns. I mean, these are things we don't like to say, but this happens. I think you realize your risk appetite when markets go south. I think a lot of people have realized the reality of equity investing, and a little bit of maturity comes after every correction. It came after 2008. I think some of it is coming after 2020, which is why I said I don't think it's necessarily a bad thing.
Swaroop, a cynic, and I'm not a cynic really, but it's my job to ask questions, so I'm doing that, right? A cynic would argue that the industry, on our shows as well, right? The mutual fund show, we tell people to be staying invested, right? Because the bottom is for the person who is investing either through the SIP or the lump sum route and staying invested. So the cynic would argue that while it's great if people are indeed taking some asset allocation calls, but all through and through, we've been telling people that, stay invested because India is an underinvested country when it comes to equity flows. So, I mean, wouldn't some part of it, I agree with Radhika on some of the points, but my question is, wouldn't this in some way be a bit of a disappointment that here's when we're just starting off on the equity culture, that things are starting to unravel at the first sign of, flattish performance? Not all schemes, of course. Maybe as Radhika said, they've got great flows, but some of the schemes, in advisors have been coming and telling us that our clients are saying that 2 साल हो गए sir, लेकिन return positive नहीं आया है और FD में पैसा बढ़ा है तो पैसा निकालना है. Is that a worry?
See, I mean, when you look at investing is about life around you also. I mean, the mood that life around you brings you to a position to where you start investing. And when you look at it at this moment, your best asset class in the country, which is real estate, is going through a phase where the government itself is incentivizing the sale of real estate, right? By dropping stamp duty. So it's not just equity. I mean, look at life around you, and Radhika sort of talked about the economic data which will unfold, and you cannot also dissociate the other factor which you pointed out of people not making money for some period of time, and the future not looking exactly positive in the near term. So all that adds up. I mean, when you look at disappointment, I think for me the disappointment was more in March than now. What is happening now is a factor of all this, but what happened in March is something all of us, all market commentators have to reflect on. We talk about buying on dips, and here was the biggest dip in our last 10-year history, and we missed it completely. It was probably in my career, for the rest of my career, I would definitely believe the biggest, money making opportunity in equity. Now, if you've missed that and then markets rally up, a fair amount of risk profiling happens in everybody's life. And when that happens, some of these actions do come about. I'm nobody to comment on why people are redeeming, because finally it's their money and time will tell whether they're right or wrong. But when you are in a pandemic like we are now, and many people have started thinking about life in general, such actions are not to be reflected on from a long-term perspective. And then let's face it, I look at the other side, which is a controllable for the industry, which is whether money is coming into us or not. Yes, last month 14,000 odd crores came in, which is what the industry was at a level. So it's just that some more amount is getting redeemed, which is fair. I mean, look at the last 5-6 years flow. We've, as Radhika rightly said, we've only seen a one-way sort of traffic, and this 1 or 2 months will be continuing as far as the pandemic is around us. You can't help it, and it's okay. I mean, some people should take back money time and again, and get some money from mutual funds into their account. I just hope it's positive money, and then that will reflect well on the industry going forward.
No, I mean, by all means, the point that I was making with NS Venkatesh as well a little while back in the conversation, that mutual funds can't conjure up returns if the underlying is not performing, right? And look at Mr. Market's returns in the last 2 years, 1 year, or YTD and 2 years, the numbers are negative. So it's difficult to show those returns any which way.
That is the point I was making. March was a time when you had the control level of changing your returns.
Sure, okay. Well, but assumed in that argument is that the Indian investor has now come of age and able to do that. I'm hoping that some of them are. But Sarup, again, same question that I asked Radhika. One, what's been your experience out here? Again, Sarup, I'm not asking you to comment on why the investor is doing it, but it'll help to get a sense of whether investors are doing it because there is cash flow issue at hand, or are people doing this because there is a bit of a disillusionment with regards to returns?
No, I don't think there is that big a cash flow. Yes, we are yet to know the actual impact of the pandemic on people's jobs and all. I think data will come out, but I'm sure there is some amount of it, but not to the extent that is reflecting on the flows. Because if you see on the debt side, what is happening on the debt side is just the opposite. A very special thing happening on the debt side. You're finally seeing money coming into the core funds of the debt categorization. You're seeing some brilliant flows, consistent flows happening in bank and PSU, corporate bond fund, dynamic bond funds, and the longer end of debt inflows beginning to look good. Like when you look at the equity side, typically the core portfolios, which are the large and multi-cap, get money consistently. And then I would put that corresponding on the debt side being the corporate bond fund, the dynamic bond fund, or say the bank and PSU fund. Those have started falling into place, and I do believe that the investor is now aligning his long-term goals to his long-term investments there. So money is coming in. I don't think money is an issue at this moment.
Got it. Radhika, one question that I think Mr. Venkatesh also wasn't able to answer was this large outflow in liquid funds, right? I mean, normally it happens at the last month of the quarter. It's probably happened once or twice in the past. It's happened mid-quarter. Any thoughts? Because it's a fairly large number.
I mean, so 15-20,000 crores, one in a liquid context is not very large. Do remember that for liquid and overnight funds, one thing did happen, which is that stamp duty became effective. And that has changed. So stamp duty, which was supposed to come in, I think, January, then it got deferred to March, April, finally became effective, I think, in July. So now overnight funds, the daily in and out actually makes no sense.
Oh, yeah.
liquid funds also become less attractive. So I think that's weighed down a little bit on liquid fund. Also, do realize that, again, as Swaroop said, even for corporates who are the largest investors in liquid funds, these are very, very trying times where people are trying to preserve cash first. So I don't like to read in too much into the liquid fund data between what has happened in stamp duty and the fact that corporate surpluses are actually stressed. Corporates are trying to keep more cash in hand, which you would in these economic conditions. I actually don't read into it. I would add to what Swaroop has said. I mean, our experience on the debt side has been fabulous as an industry. I think we are getting money despite all the noise in March, April around credit. We are getting money in bank PSU, corporate bond. We've seen this with some of our own long-term bond vehicles because we run the largest of those in the Bharat Bond long-term ones. I mean, they are flush with flows.
The market gravitating towards performance and not then therefore reputation of categories or funds, Radhika? I'm asking this to you because you may have gotten funds, but as a category, credit risk also has seen some outflows, right? It's 550 crores, so it's not a very large number, but there are outflows as well. And as it happens with pure equity markets listed, right, that people after a point of time stop bothering about whether they're investing in a Nifty name or a mid cap name as long as the name is showing promise. Do you think that is starting to happen in mutual funds?
I think so. I think, ours and Swaroop's experience probably is, testament to that. I think in fixed income, clearly people are gravitating towards quality. I think you see this. You see the fact that the credit risk category has shrunk from 1 lakh crores to 25,000 crores. The bank PSU category is 1 lakh crores. Bharat Bond as a program is probably 28,000 crores in a very short period of time. Corporate bond funds have grown larger. So I think the fixed income investor has probably got, equity investors have seen jolts in India. They have seen 2008, they've seen 2013. I think the fixed income mutual fund investor probably felt his first jolt in the last 2 years, and he's realized that safety of capital is important. So this has been the coming of age for the fixed income investor. So more than gravitating towards performance, I think the fixed income investor is gravitating towards quality. And I think that is a very good thing. If people are gravitating rather than, I always say, even at the box office, the size of a movie doesn't matter, the budget doesn't matter, the quality matters, right? So if people are gravitating towards quality, it's a good thing.
Swaroop, the investor who wants to come in and she's wondering about what to do now because the sentiment is looking a bit sour, and let's face it, there is uncertainty around over the course of the next 3 to 6 months at least from the looks of things, if not more. Would you reckon that equity, without getting into predictions about where the flows will come in, but what is it that you as a house are right now doing in these times wherein, even if we don't like it, the flows data that comes out like this and that headline number of minus 14,000 crores does have a bit of a bearing. I've seen it in my Twitter account, for example. A lot of people are saying that, oh my God, what's happening?
See, Neeraj, we've been a very boring fund house, and the challenge is to make it more boring tomorrow.
Boring is beautiful, yeah.
Yes, and all that effort that we had put in over the last 8, 9, 10 years into building an SIP book is holding us in good stead at this moment. And that is what we'll continue to do. At this moment, from an Indian mutual fund perspective, I think we are on a threshold of a very, very defining moment where we will see the inflows being very different from the past inflows. I say this because two things are happening. One, at the underlying, this digitalization of the entire industry will play out permanently now, and then that will have its own ramifications. We are already seeing the ramifications on the demat accounts opening and the subsequent. If you see this month's flow, there has been a very decent flow on the ETF side also. It's probably skewed to gold and all a bit, but the fact is ETFs have started getting money is a reality which will start. Whether the debate of active versus passive will give way to active and passive from this time onward. At the underlying in everybody's personal life, he or she has been able to differentiate between need and wants in this 6 months of sitting at home. It is a great time for an advisor to enter anybody's lives and differentiate this need and want and build a very good finance expense statement going forward. So I do believe that COVID is that kicker that was needed for financial advising to start, and we will see that happening in a big way. Once that happens, then markets take a back step to inflows. What takes the front step the first step is the allocation. And that's something which I see happening going forward. People will make their inflows based on their allocation rather than looking at market movement, which is definitely not under their control. We have said this, but I do believe that COVID is that trigger which was needed for a comprehensive financial plan to set into the country. Please keep in mind that the demography of the investors in the country is becoming younger, and they will probably kickstart this, is my firm opinion.
Yeah, interesting. I was reading some story, I think, on my website or somewhere else about how Paytm has opened some number of SIP accounts as well. Actually, just before I ask the final question to Radhika, Swarup, just a quick follow up. I wanted this clarity, and I didn't quite get it earlier. Somebody was telling me that if indeed the online platforms have seen folios uh, being very passive or inactive because the SIP book was stopped in that folio and then no activity has happened. And if there is a closure as well, it has not been accounted or is not getting accounted for in the number of folios added minus deducted. Do you see any merit in that argument or no?
No, I think now what is happening is, as far as I know, the live account or the banked SIP account is being taken into consideration. Radhika is part of some of the committees; she can tell me better. But from what
Okay.
I believe, in the last 2 months, whatever is the money that is banked by all of us on the SIP book is what is reflecting on the report. Is what I don't get into the technicality, but I know for sure that the money in the account is the money that is being reflected.
No, which is fine. So not the money, but Radhika. Okay, let me ask you. What I was given to understand was that if there is an online platform on which there was an SIP folio, and if the
Yeah.
folio, let's say, stopped in April or May, and if the
Mm.
person has closed the folio, it is not
Yeah.
being accounted for in the number of folios or net folios addition in the mutual fund community. Is that true, or you don't think that is possible?
When we report folios, as I understand, we don't report zero balance folios, online, offline, etc., etc. Someone correct me if I'm wrong, but I don't think we report zero balance folios.
Okay.
So if the folio has zero balance, then it should not be accounted for, right? Because I mean, for instance, many of us will have zero balance folios, but your number of folios is the ones that actually have money. Like I acquired JP Morgan. I mean, I have lots of old zero balance folios.
Got it. Okay. Fair call. Radhika, one final thing, and that is on this category that I think must be picking up for a lot of people, which is the international investing thing, right? It's suddenly picked up steam. What kind of interest are you seeing there? Swarup, I don't know if you want to add something to that, you could, but Radhika, I want to start off with you on this.
Yeah, no, we've been running international funds for donkey's years since we acquired the business from JP Morgan. And I would agree with you, never in my career have I answered so many questions around international funds as I do in webinars these days. I think it is broadly a good thing with some caveats. I think if you talk about asset allocation, then having so much home country bias is not very wise. So it is important to have international as a part of your asset allocation. I think there are opportunities that you don't get access to in India in international markets. For instance, technology is a theme. I mean, your whole 5G and cloud and everything, you just don't get access to in our markets, which have Infi, Wipro, etc. So I think there is a great access story. There are markets like China and emerging markets. So I think there's a great story around access and diversification. My only caution is that people should do this for the right reason, which is what I keep saying on these webinars. Don't do it, one, because the last 1 year returns were good, because that's a bad idea. And second, don't do it thinking this is less risky than equities. I mean, even my US tech fund is actually riskier than Indian equities. So do it as a part of asset allocation and do it for the diversification benefit. I think international investing is here to stay. In fact, we'll have a very interesting India plus international NFO coming up in the next 3-4 weeks. But I think the category is definitely here to stay.
So, you reckon it'll get more flows?
Yeah, I mean, from an international perspective or normal perspective? International?
International perspective.
I think, like Radhika
You
said,
could add with the normal perspective as well.
yeah, normal. I'm not seeing per se. Till the pandemic is there. I think this is the trend. That's my opinion. But see, like Radhika said, as long there is a space for allocation for international, definitely in everybody's portfolio. Investing outside India will just start because some of the data on alpha is beginning to play out, and that's when all these things come into play, right? But point that has to be made, which Radhika sort of said, is there's no point buying after for a reason of last 1 year performance. That's true about international investing. That's true about gold. That's true about gilt. That's true about healthcare. I mean, when we launched the healthcare fund 2 years ago, nobody listened to us. Right now, on a monthly basis, we are getting more than the NFO period. How is that fair? Now, if I tell somebody that, say banking consumption are not looking good, you must buy them, they will laugh at me. But that's what it is. It is never wise or prudent to look at near-term 1 year return and invest. Unfortunately, that is what is happening. And you see, suddenly 1 month the gilt is showing negative outflow. How does that happen? I really don't understand that at the underlying. So these are caveats in investing, and one has to become prudent. We cannot say that we don't have experience anymore. This is now the 25th year of AMFI and 25 years of track record in the industry, which is unblemished across categories. Okay. So people have to recognize these facts and build good portfolios. There is a time left for, I always say, there is a risk to investing in equity. There is a risk in not investing in equity. Please keep that in mind and invest in a prudent manner will be my basic submission.
Great, both of you. Thank you so much for taking the time out and speaking to us today. And all the best with your fund management.
Thank you.
And cheers. And viewers, thanks for tuning in to this conversation.